Welcome to Module 1 of our Seeking Capital series. This series is being brought to you by the Thurston Economic Development Council's Center for Business and Innovation. The CB&I offers free support to local business owners, including how to find and prepare for capital infusion. ThINk is the Thurston Investment Network and is a program of the CB&I. Local investment networks such as ThINk are just one of several options that may be available to you when seeking capital for your business. For more information on ThINk and the resources of the CB&I, visit the Thurston EDC website. In this module, we will look at seeking capital through an investor. We will review some common terms you should know, explore the different stages of growth a business will go through, and take a closer look at investors and what makes them tick. Let's prepare by reviewing some of the terms that appear in this module. You will want to be familiar with these and other terms before you reach out to investors. An investment comes in one of two forms, a loan or equity. A loan is a sum of money borrowed that is expected to be paid back to the investor over a set amount of time with interest. For investment purposes, equity refers to how much of an ownership stake an investor receives in a company for the amount of money they are investing in it. An angel investor is a wealthy individual who invests a large amount of money in a new business. A venture capitalist is an investor that provides capital to companies exhibiting high growth potential in exchange for an equity stake. Raising capital for a project or venture by using the internet, typically, to collect many small amounts of money from a large number of people is known as crowdfunding. Now for a couple of acronyms. ROI, Return on Investment. LIN, Local Investment Network. Before asking someone for money, you will want to gain a realistic understanding of what stage of the growth cycle you are in and who would most likely be willing to invest in you. Let's review different stages of growth every business will go through. Let's review what types of capital are most likely available at each stage of growth. The idea stage is where you began or where you are now. You have a thought in your head, perhaps some drawings on a napkin, and little else. You are still developing the concept. At this stage, you are self-funding. You are, in fact, your first investor. You will then most likely turn to friends and family for a loan. This is an important step. For starters, you're bringing in outside money for the first time. Secondly, you're learning how to be responsible with other people's money and meeting expectations. Other options at this stage might be a loan or crowdfunding. Now that you've developed a strategy, you're ready to move into the seed stage. Here's where you will get serious about putting your idea into action. If you're looking at bringing in an investor, you will need to convince that investor that your idea is worth their attention. Investors at this stage are most likely individuals who invest smaller amounts of money into projects they believe in. The amount of money at this stage is most likely under $100,000 or so, as you are still a big risk. Avenues to capital at this stage might include angel investors or local investment networks such as ThINk. You will negotiate with these types of investors individually regarding amount, terms, whether a loan or equity, and other factors. If you're in certain highly sought after fields, such as tech or biomedical, or your business model is scalable, you may be able to attract a venture capitalist to back you. They will most likely want equity in the firm, however. At this stage, you are most likely too risky for commercial lending, but the Small Business Administration has micro-lending programs that just might fit. Once you've generated some revenue and you're ready to grow, you will most likely need another infusion of cash to get you moving. You might be in an early growth stage or in a recovery stage due to something beyond your control, like a pandemic. But either way, you are now a bit less risky as you have some sort of track record behind you. Banks may now be an option, as well as your local investment network, such as ThINk. Local investment networks are a great option as they want to see local companies thrive and grow. If you've grown your original business successfully and now want to expand, your options are more flexible. You might be able to negotiate revenue-based financing or get larger short-term loans from the bank. Your local investors are also an option. Our suggestions are general, and your situation may require a closer look. You will find many free resources available for small business owners no matter what stage you're in. Visit the Thurston EDC webpage for links. Let's take a closer look at investors. The most common ways to get capital infusion is via a bank or an investor. So what are the differences? Why would you pick one over the other? Well, here are some things to consider. An investor is taking a big risk. They may be looking for a higher rate of return than a bank might. An investor may want an equity stake in the business. This means they will have ownership in your company and may have some control over what you do and how you manage your business. Working with individuals on investments can lead to some creative deals. You will want to make sure you completely understand the terms of any deal you make. Since the investor will have a personal interest in your success, they may be able to provide more than just money, such as guidance or other personalized assistance. This can be priceless to a new or budding entrepreneur. A bank, however, has little personal interest in your business. In fact, the only interest they may have is the interest they get when you pay the loan back on time. Banks are going to tell you the terms of the deal, and you will not have quite the personal relationship that working with an investor might bring you. Since we know the motivation behind why banks are giving you capital, let's explore why the investor might want to lend you money. The investor will be evaluating you. You also need to know who they are. You will want to understand the motivation of a potential investor in order to secure the best deal possible. Who are they and why are they investing? Some common reasons someone might invest include: they may be an expert at recognizing market opportunities in a certain market niche. You should also ask any potential investor what their area of expertise is, so you know if this person falls into this category. They may invest in compatible markets and can help you by leveraging current relationships. They may be supporting a cause, say environmental companies, or encouraging the growth of local businesses. But there is one trait they all share. They're all in it to make a lucrative deal. So they will want you to be very clear on how likely they are to see a return on their investment. They will expect that you are knowledgeable about your business, competitors, and potential market, and that you are capable of making a mutually beneficial deal. An investor is going to want to feel like you're a safe bet. You will want to lower your perceived risk as much as possible so you can get the best deal with the investor or bank. When dealing with investors, you will communicate your idea and risk level via your pitch. This pitch will outline your idea, your solution, and your ask, including the rate of return, duration of a loan, and valuation or amount of ownership you give up for equity. Keep in mind, the lower your risk, the better the deal. In Module 2, we will explore how to most effectively pitch your idea to an investor. So let's review. Before seeking capital from anyone, you should understand there are different kinds of funders. Are you looking for an investor? If so, what kind of investor? You will want to be able to show that you have already invested in yourself and therefore have skin in the game. And you should be able to identify and address your risk level. In essence, what can you do to show yourself and your idea off in the best light possible? Start thinking like an investor. If you were going to invest in someone, what would make you feel most comfortable? Join us in Module 2 as we look at pitching to investors.